This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Harley back on the show. You know, while we call him the convexity maven for his knowledge on bonds, he's also so smart when it comes to options and options trading. I just absolutely loved his ideas on the S&P 500.
Patrick, I know exactly what you mean, because as soon as we finished taping that interview, he hit me and said, hey, I got a couple of suggestions for you to pass on to Patrick. And he's going off around the theta decay of the gamma, X-ray, negative, whatever. And I'm like, I think you should talk to Patrick directly about that one. So maybe we should get him back onto the postgame in a future episode so that you guys can go heavy on the option Greeks, and I'll try to keep up. But in any event, let's go ahead for today's show and take our listeners to this week's postgame chart book. It's called Breakouts or Fakeouts. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage at MacroVoices.com, click on the red button that says Looking for the Downloads. Patrick, breakouts or fakeouts, starting on page 2 here with the euro against the US dollar. What's going on?
Eric, what I wanted to focus on was just bring a whole bunch of charts to our listeners' attention, just some really interesting things that are happening in the markets and setting up. And I think they're really important to watch as to whether they emerge as new major trends or whether or not this is just noise. And so I figured we play a game of breakout or fake out and see what we think on all of these. So on chart 2 is arguably the most important one, because we always talk about the US dollar index, but the US dollar index, more than 50% of it is weighted against the euro. And so really, as goes the euro, goes the dollar index. And one of the big questions everyone asks today is, are we entering a period where the US dollar is going to enter some sort of a bear market and begin a sustained decline that will impact inflation and commodities and all sorts of other areas? And what I thought was really interesting is when you go and zoom out and look at like the last 5+ years of the euro, and we overlay on a weekly chart the volume by price, showing what price levels, very large amounts of the volume has transacted, one can see we're slowly approaching the top of this band. This is a big trade range between like 108 to 114. And while we've certainly had 2 very meaningful spikes higher in the euro this year, the real big question to solve is this setting up for a big breakout? Are we about to see that US dollar breakdown and the euro breakout here? And watching whether this plays out, that breakout above that 114, 115 is probably one of the single biggest intermarket macro events if it does play out. And that's definitely what I'm watching. My intuition is it doesn't happen, but if it does, we can't ignore it, right? What's your take on the euro?
I agree with you, Patrick. My intuition is it doesn't happen. I think we might have already seen the top there. Maybe we'll test the top of that range one more time. But I don't think we see a full breakout. Something like a daily close over 1.16 would really say to me, oopsie, we got that one wrong. If that's the case, I'd really be watching for the bottom to fall out on the dollar index, because the euro makes up the biggest portion of it. But my gut feeling is that you're right, that it's probably done here and that we're going to see the dollar strengthen. The reason that it would change that view would be if the Fed gets into another round of stimulus in response to more bad coronavirus news. If the Fed responds with even more stimulus reaction, that could be what pushes us up out of this trading range, and maybe it starts to run away from there.
All right, well, let's move on to page 3, where I just wanted to look at the commodity complex broadly, and this is the Bloomberg Commodity Index Futures. While we'll look at some individual commodities in a moment, what I thought was particularly interesting is that commodities have not really started to rise in any meaningful way on a broad basis. And this, to me, is one of the areas to watch, whether or not the inflation boogeyman is really going to come out and we see see sustained rising inflation expectations. You would think that broader rises in commodities would be accompanying that. And rather than seeing, sustained higher highs, higher lows, and a clean uptrend, this has not been able to really get off the mat. And in fact, it almost feels like it's rolling over. And so is this going to be a fresh new breakdown in the commodity index, or is this just more of a bottoming formation where this is going to maybe retest some of these bottom ranges and turn up? And I really do actually think a lot of this will be linked with what happens with that euro US dollar chart as well. And watching whether this breaks down in any meaningful way is really important. Do you have a perspective as to whether you think this is going to break down?
Well, I would say the same thing that you just said. I agree with you on the U.S. dollar to euro correlation, but I also think that inflation expectations are really where it's at. You listen to a lot of our smartest guests. They're all saying, look, it's definitely coming. But you know what? It's still a couple of years off. And what this chart kind of says to me on page 3 is, okay, we're having the little inflation scare here, and maybe we're going to go down to a new bottom or, a slightly lower low, or just stay in a consolidation pattern. Maybe what we're seeing is that low from back at the end of March versus the high that we hit in early June. Maybe that forms the upper and lower bounds of a consolidation range, and we just consolidate for the next year or two before inflation expectations really start to take off and drive commodities higher. Now, if you look at this chart on page 3, that one tiny little red candle below the blue line there doesn't really, it's only one itsy bitsy little candle. It's just barely below the line. It doesn't say much. But if you move on to page 4, it's just one particular commodity instead of the whole index. But boy, if that's a leading indicator in what corn's doing, you've got the same basic picture, but that breakdown is much more pronounced. So maybe that's an indication of things to come for commodities more broadly.
Yeah, let's say when we pull up oil charts, of course, oil and gasoline and everything have been moving relatively higher. But when you really look at the grains as an aggregate, like whether you're looking at wheat, which has been pretty weak, soybean hasn't been able to really get anything going, nor have there was actually some crazy price action in rice futures. And really corn here, very distinct break on the downside, is just in this segment of commodities. There's nothing happening right now. They all look like they're rolling over, very weak, and it doesn't seem like there's an imminent bid coming in here. And so, to me, these look like they're breaking down. And it's to me they look like the early stages of the breakdown a month ago on natural gas. And it's just sometimes these commodities break on the downside, and they can't seem to get any bids, and they just bleed out. Anyway, this corn chart looks pretty weak. Nonetheless, I wanted to move on to the one commodity where there is some really interesting strength, and that's on page 5, and that's on the lumber futures. And, it's interesting because when you look at a lot of the housing stocks and even some of the other home builder components, things like Home Depot or Lowe's, they all seem to actually be behaving like there's some sort of a new bull market. It's certainly where there is relative strength. And over the last week, these lumber futures really started to move to the upside. It's going to be one of the really interesting things to see whether or not this bumps its head along these highs from February, or whether this is a legitimate turn, because the lumber prices actually had much higher prices when you look back a year or two. And so the question here is this just going to be a tap into this previous high, or is this a real breakout? That's one of the big questions to solve.
Patrick, let's move on to gold on page number 6, because as you're showing here, there is one downsloping trend line that we've broken through. But if you thought about this as a horizontal consolidation pattern, we really haven't seen a breakout yet. How do you read this one? I mean, it looks like the way you've drawn it here, you're kind of showing the breakout version as opposed to the fake out version. Does that mean you're expecting that, or is it just one way of drawing the line?
Well, at this moment, whenever you have a breakout, often the better thing to do is to give the bulls the benefit of the doubt that they'll make it stick. I mean, I think at this stage, they're clearly attempting to take gold to the next level. And obviously, we were talking about that 1922 previous high, but there is that measured move that measures all the way to 2000. And so if this breakout sticks, there is plenty of upside on gold, especially after spending 2 months consolidating consolidating. So that kind of unwinds the overbought state from that advance back in March and April. And so it really can slingshot higher. And so watching this over the next week to see whether this breakout is actually for real is going to be huge. It's one of those ones that we've been waiting to see if it breaks out, and it's attempting to do it. So that's on my radar.
Patrick, I couldn't agree more. If we see the price of gold move above 1785 off the top of my head and stay there for several days, it really suggests that the next move higher is upon us. And as you say, that next move could be substantially higher. And, as much as I want to say, well, keep in mind, folks, we are overdue here for a steep technical correction. I've been saying that for months. This consolidation sideways here has been going on since the beginning of April. So, we're already into almost 3 months of consolidation. A decisive breakout above the consolidation kind of invalidates that expectation of a lower number. And I'm tempted to say, well, a stock market crash because of the coronavirus could pull it down. Well, the thing is, look at the stock market. It's not crashing. If anything, it seems to be expecting more stimulus as a result of the coronavirus to carry the market higher. So I think the odds are on a move higher from here.
So, Eric, on page 7, I want to move on to the Palladium Futures. And what was interesting here is because we showed the chart on gold. And one of the things I would always like to see is to see a number of the precious metals all confirming this. And in the particular order, silver made it all the way back up towards its previous high and is kind of flagging for a potential breakout. And platinum has tried to get off of the worst levels, but is a little bit weaker than silver. And then there's palladium here, and palladium seems to actually be actively distributed. Almost every rally seems to be sold, and it continues to just show signs of potentially breaking down. And I don't know, maybe we have some listeners that are more in line with understanding what's going on in these precious metals markets, but I find it, at least I would have really liked to have seen all of them kind of behaving in a much more bullish manner to confirm gold. And maybe that's a warning. We'll have to watch, but it certainly looks here that palladium is breaking down. What's your take?
I think that silver is the important confirmation signal for gold, and we are seeing signs of silver echoing the bullish patterns that we're seeing in gold. So I think you got your confirmation there. Platinum and palladium futures, honestly, there's a lot of fundamentals that have to do with automotive applications and so forth that I don't fully understand it. It's not my area of expertise, so I don't really know what's going on here. I'm sure we probably have listeners who could tell us exactly what the cause is of this. But as far as looking for a confirmation signal to validate the gold chart, I think silver is giving you a pretty strong message.
All right. Well, let's move on to page 8, where I just wanted to revisit these high-yield bonds or junk bonds. And we've obviously had a very strong recovery off of those March lows when the Fed gave indication that they would consider buying some of these ETFs to provide the liquidity to keep a stable bond market. But after seeing this initial strength in April, really, junk bonds have not been able to make much higher highs, and they're not really gaining any momentum. In fact, they're losing momentum, almost like if they're slightly rolling over. I wouldn't call this a breakdown yet, but certainly they've stopped participating on the upside and have been lagging. So the question here, do we finally see this rollover in junk bonds? Do they break to a lower low? Do we see that this area of the market starts to show weakness? This is definitely something that's on my radar to watch.
Well, Patrick, I think that certainly if you were long junk bonds, getting out of them would make a lot of sense. As far as shorting them, though, I still wouldn't dare. And the reason is we've seen the Fed clearly signal that they intend to support the junk bond market. So I think if you saw a crash in junk bonds, and I do see plenty of economic fundamentals to support exactly that, I don't think the Fed would let it get very far before they intervened again.
All right. And finally, on page 9, just the S&P 500, right? And this is obviously, I'm a little bit bearish, and deep inside there's a bear tucked away. And I was looking to see whether this S&P rolls over in some meaningful way. But often when you had such a big advance in the markets, there's going to be a period of correction where it backfills the rally, consolidates, and then uses that base to begin a new advance. And I think one of the more interesting puzzle pieces to solve here is this just the market taking a breather and backfilling some of that previous rise before it has a continuation? Or was this it? Has the bear market rally really kind of played out, and is the market now rolling over? It's one of the more interesting things to observe which one of these play out.
Patrick, I see this one purely as a tug of war between economic fundamentals, which definitely call for lower equity prices because it is a bear market rally, and there's lots of economic reasons to expect much lower equity prices according to old normal rules. The other side of the tug of war is we've got the new normal where central bank accommodation plays a bigger role than economic fundamentals in stock prices, and that would support the case for higher stock prices, maybe even new all-time highs. So far, as much as it frazzles me, it seems like the central bank accommodation side is winning the tug of war over economic fundamentals. Now, do you make the argument that, well, the economic fundamentals have to win in the end? Or is it just the ability of the Fed to conjure unlimited amounts of money out of thin air that wins in the end, as seems to be the case? I don't want to bet either way, frankly, from what I see here. But where you can find a sure bet, folks, is a free trial of Patrick's service, Big Picture Trading. Take a look at page 10, where you'll find all the information you need to get a free 14-day trial to Patrick's service.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.